Hey everyone, welcome back to another episode. Order blocks are widely recognized as powerful areas for identifying high-quality trading opportunities. But have you ever wondered why some order blocks perform extremely well, while others seem to fail or get completely ignored by the market? To uncover the answer, we conducted extensive backtesting on more than 100 order blocks across multiple market conditions to identify the defining traits of high-probability order blocks. We applied a variety of rules to analyze whether they actually improve the overall win rate, and the insights we gathered were truly eye-opening. Our findings revealed that order blocks perform best when specific market conditions and repeating price patterns are present. So in today's video, first, we will break down the foundational rules and demonstrate a simple yet effective trading setup for order blocks, along with real backtesting results. Then, we will dive deeper into the exact conditions that create high-probability order blocks and explain how you can significantly improve your trading success. If that sounds useful to you, make sure to hit the like button to support the channel and subscribe if you're new here. We consistently share advanced trading strategies and concepts. The primary rules of order blocks. Let's start by explaining the core principles behind order blocks within smart money concepts. Essentially, we define the order block zone as the final candle that produces inefficiency, which is where major institutional decisions are believed to occur. Sometimes, this candle appears at the start of an impulsive move, and other times it forms midway through the price action, either in the same or opposite candle direction. There are three essential rules for identifying a valid order block. First, it must create inefficiency. Inefficiency forms when sharp price movements generate noticeable gaps between candle wicks. Here are examples of efficient versus inefficient price movement. Second, the order block must trigger either a break of structure or a change of character. These events provide the first indication of whether the market intends to continue in the same direction or reverse. Third, the order block must remain unmitigated. Order blocks function as single-use zones, meaning we only look for trade entries on the first price tap into the zone. On the Euro-Dollar 15-minute chart, we can clearly identify several order blocks by locating strong inefficiencies that led to breaks of structure or character changes. Each of these zones qualifies as a valid order block based on our rules. Trading strategy and backtesting setup. Now, let's go over the trading approach we used during our backtesting phase. The rules are straightforward. First, locate a valid order block. Next, place your entry at the beginning of the zone, while positioning your stop loss at the opposite end. We aim for a 1-to-2 risk-to-reward ratio, meaning we target double the distance of our stop loss. With this structure, even a 34% win rate keeps us at break-even, ensuring long-term sustainability. Backtesting results. We tested this strategy across 100 order block setups on the Euro-Dollar 1-hour time frame. Out of 100 setups, 28 trades were never triggered, 41 resulted in losses, and 31 reached full profit targets. This produced a 43% win rate with a maximum drawdown of 10%. Despite the win rate being below 50%, the strategy delivered a 47% account growth, proving that proper risk management and structure outperform raw accuracy. During testing, we also discovered that when specific conditions align with order blocks, win rates improve significantly. Additionally, recurring price patterns emerged that greatly amplified trading returns. Market structure. Let us start by examining market structure, one of the most important filters for identifying high-quality order blocks. Certain price patterns appear repeatedly across the markets, and recognizing them dramatically increases accuracy. When an order block forms above another valid zone and a price gap exists beneath it, price often seeks liquidity lower before resuming its main trend. In such cases, we reduce confidence in the upper order block and assign it a -1 rating. On the other hand, when an order block forms after liquidity is swept above highs or below lows, we assign it a +1 rating for trading probability. This indicates that the market has collected liquidity, fueling continuation moves. These patterns repeat constantly across all time frames and markets. On the other hand, observe this second pattern. Here, we have a valid order block, and when we analyze the left side, we can clearly see that price has swept the liquidity beneath these equal lows, which can fuel upcoming price movements. So whenever this structure appears, and we see an order block that collects liquidity either below equal lows or above equal highs, we assign it a +1 rating for trading. The third pattern closely resembles the second one. Suppose we have an order block ahead of current price. As price moves toward this zone, it forms support where retail traders tend to place their stop-loss orders. As a result, there is a higher probability that price will sweep the liquidity beneath equal lows and then continue moving upward once it reaches the order block zone. So, let me show you a few real chart examples to clarify this concept. Here, we have the euro-dollar on the 1-hour time frame. We can identify this valid order block that produced inefficiency and a break of structure. But when we look to the left, we notice this support level that rejected price multiple times. Therefore, a significant amount of liquidity is resting below this level. Additionally, we see price gaps directly under this area along with another valid order block. So there is a strong likelihood that price will break below this liquidity pool to fill the gap and then continue upward once it taps into the second order block. Here is another example. You could have selected either of these candles as order blocks. We observe a clear price gap, a break of structure, and a buildup of liquidity beneath these equal lows and this mitigated order block. So when price breaks below this higher low, some traders may interpret it as a change of character. However, by analyzing the left side, we can spot a clear gap and a valid order block directly beneath this zone. So there is a greater probability that this move is simply a liquidity grab, and we still consider the market structure bullish. Now, take a look at this bearish example on the euro-dollar 1-hour time frame. We can clearly see a strong downtrend. We identify this order block that generated a clean inefficiency and a break of structure. But what makes this order block especially interesting is that the beginning of this move is a liquidity grab. Therefore, this represents a +1 trading opportunity. But here's a crucial reminder. Every losing trade does not automatically mean that your analysis was incorrect. Keep in mind that no trading strategy works all the time because market behavior cannot be controlled. The second factor you must consider when trading order blocks is market volatility and spread. When we examined our backtesting data, we observed that most profitable trades occurred during high volatility days and sessions. Typically, the first and last trading days of the week experience lower liquidity, which explains why the majority of winning trades occur midweek. Additionally, a pair such as euro-dollar performs best during high volatility sessions like London and New York. Otherwise, trading becomes less effective since price movement remains limited. Another critical factor when trading order blocks is managing spread. Many times, price reacts within just 1 pip of an order block. So using a pair with a wide spread can cause you to miss profitable trades or prematurely trigger your stop loss before price actually reaches the zone. The third factor that influences the success of order blocks is the overall market trend and their freshness. Order blocks perform significantly better during trending markets compared to ranging conditions. As a result, it is more effective to trade order blocks that align with the dominant market trend. Additionally, recently formed order blocks tend to be more accessible and reliable because market direction changes frequently, and waiting too long for price to revisit an older zone often leads to losing trades. Since supply and demand are continuously battling for control, market trend and recent fresh order blocks typically produce higher win rates. Here on the euro-dollar, during a strong trend, notice how frequently price creates fresh order blocks, reacts to them, and continues moving upward. On the other hand, consider this example. We have a valid order block zone, but before price reaches it, the market forms multiple demand zones and breaks them to the downside. Some traders may interpret these breaks as liquidity grabs and place buy positions on the order block. However, the key point is that sellers have taken control, and trading this order block without confirmation becomes ineffective. That's why confirmation on lower time frames becomes the next critical factor when trading order blocks. Confirmations help us avoid many unnecessary losses when the market decides to ignore an order block. They also provide a stronger execution plan, allowing us to trade with greater confidence. The order block trading approach is not restricted to any specific time frame. However, after identifying order blocks on higher time frames, we drop 2 time frames lower to search for precise entries and confirmations. So, when we use the 4-hour, 1-hour, and 15-minute charts as our higher confirmation time frames, we look for trade entries on the 15-minute, 5-minute, and 1-minute charts respectively. Multiple price action setups can be used as confirmations when trading order blocks. Here are some of the most common patterns we apply in live markets. First, we wait for price to mitigate the higher time frame order block and then observe how price reacts. The initial signal we look for is a change of character. This change indicates that the short-term trend has shifted and price may start moving in the opposite direction. Once a change of character forms, that's when we prepare for trade execution. Typically, we observe two recurring entry patterns. The first setup occurs when the change of character creates inefficiency along with a valid order block. In this case, we place our entry a spread size above the order block and set our stop loss a few pips below the lowest point of the zone. We apply a simple trailing technique to capture large risk-to-reward ratios without unnecessary stress. If price moves in our favor, we trail our stop loss beneath market structure each time a new higher low forms. This allows us to ride the trend until price reaches a higher time frame supply zone, where we exit the trade. The second pattern appears when we have a change of character, but no inefficiency is present. In this case, we use Fibonacci retracement levels. We draw the retracement tool from the start to the end of the impulse move and place our buy order between the 618 and 786 levels. Our stop loss is positioned a few pips below the swing low, and we target the next key structure level. Always remember that these trading strategies can be applied to any market or time frame, but thorough backtesting is essential to determine what works best for you. So guys, if you enjoyed this video, please hit the like button to show your support and subscribe if you're new to the channel. Thanks for watching, and I'll see you in the next episode.